Hello, everyone, and welcome to our Paycheck Protection Program Loan Forgiveness Part 2. Please keep in mind that we have a Part 1 of this video, and the link should be showing up here as an action item for you. If you have not viewed Part 1, please go back and review that video before you watch this video here for Part 2, as we will be covering different areas of forgiveness. In the CARES Act specifically, it stated that Treasury must provide guidance 30 days after the act was signed into law. So the guidance is overdue, could come out any day now, and of course we will be updating accordingly. But we felt that it was important to still provide some guidance into the sections that we're paying close attention to and address some frequently asked questions that are coming in. But today, just keep in mind that more guidance is still coming. I have a few members of my team with me today. I'm Diana Murray with ASAP Accounting and Payroll, and I also have Mark Betts on the line with me as well, and Richard Betts. And we have today Michelle Kooi of Tafoya Barrett Associates. And we're excited to have her insight and to be collaborating with her on providing guidance in this very confusing area. And so with that, I'm going to kind of outline what we're going to talk about today. And we are going to kind of cover these areas. And again, if you haven't watched the first video of forgiveness, go watch that video, as that's going to cover a lot more into the forgiveness overview. But we're going to touch on the updated guidance that came out from Treasury on May 6th, and we're going to talk about expense deductibility, areas that are still very unclear, different calculation tools that you can use as samples until we see some standards come out there, and as well as address some FAQs that both of our firms have been seeing in the last couple weeks. So with that, I'm actually going to start today. So just to kind of set the tone here, revisions are coming out frequently, and the latest revision from the Treasury FAQs was on May 6th. And again, more guidance is coming, but here is what we're paying attention to today. And at that point, I'll turn it over to you, Michelle, to talk about the expense deductibility updates.
All right, thank you so much for having me today. So the expense deductibility, it came out with this IRS notice 2020-32 this week. And this is a bit of a bone of contention. So the IRS ruled that business expenses that are paid with the PPP loan funds and later forgiven can't be claimed as deductions. So you would have to remove those as a deduction for tax purposes. We're understanding now that that was not the intent of Congress when this whole program was passed. And so accounting professionals, the AICPA, and Congress, as well as small business advocates, are all pushing to reconsider this rule and actually overrule the IRS. It's currently with the Senate Finance Committee. A bill was actually submitted just this past Tuesday, and we're awaiting to see what will come of that. But that really reduces the impact. This notice reduces the impact of the PPP forgiveness loan by not being able to deduct those. And that really, again, was not the intention.
Are we concerned as a business owner, would that be like a 25% tax essentially on the loan amount? How would you, if the Treasury guidance sticks and you cannot use the expenses, deduct the expenses, what kind of quick calculation can a small business owner use to understand what burden that creates for them?
So my understanding, the number that I've seen is around a 30% reduction in the benefit that you would get.
Okay.
So it's a pretty sizable number.
Yeah, definitely.
So kind of moving into our big section here of a lot of things that are still very ambiguous in the FAQs. And so we're going to touch here on a few different areas of those FAQs.
So what is still unclear? There's a lot still unclear that we have to cover with loan forgiveness. And the number one thing is related to full-time employees or full-time equivalent employees. Question 36 in the Treasury's FAQ goes into the standards that were used by the borrower to establish that they were eligible under 500 employees. But it also, at the very end of this statement, says, by contrast, for purpose of loan forgiveness, the CARES Act uses the standard of full-time equivalent employees to determine the loan forgiveness amount to the extent that it will be reduced due to workforce reductions. What does that mean, full-time equivalent employees, exactly? And so the definition that we're seeing is that similar to the Affordable Care Act methodology. For accountants out there, you may understand that. But essentially, any employee that works more than 30 hours is considered a full-time employee, counting as one. And then all employees that work less than 30 hours a week, part-time employees by this definition, have their hours totaled amongst all other part-time employees and then divided by 30 hours a week to arrive at what's considered a full-time equivalent employee. That gets a little complicated as you look at work weeks, because most payrolls are not weekly. Most payrolls are either monthly or they're tracked on a biweekly or semi-monthly basis. So from the payroll perspective, our operations are providing these reports based on a pay period calculation, because that's the best information we have available. But it'll be interesting to see if the lenders down the road want you to go back to even your timekeeping solution to export that on a work week basis. We hope not, but for that purposes for now, we're also looking at the reference or baseline comparison periods of February 15th, 2019 through June 30th, 2019, and we're also looking at January and February periods. And so that seems simple enough. But there's still a lot of gray in this section because, for instance, are you supposed to look at those periods of time based on work weeks or day of the week worked, or are you looking at that time period based on the payrolls that were dated within that time range? And what standards exactly are they going to want to look, and can we get some consistencies there? And probably we're going to see a lot of also confusion when it relates to going forward and working with lenders. We've already seen some lenders, when questioned about this baseline comparison period, say it should have been that they're going to compare it to the employee count that was put on the SBA application originally. So we hope that the lenders and the accountants can come to some sort of uniform conclusion on these definitions and methodologies for arriving at these counts. We're concerned that this is a next frontier that we'll have to work through with all the lenders and come to some sort of standardization. We hope Treasury will kind of come up with some more guidance on this, but there's no telling at this point if that guidance is going to arrive or not. Also, what's unclear is the wage level calculation that's referenced in the CARES Act, and the amount of loan forgiveness can also be reduced by the amount of any reduction in wages, as described in subparagraph B of page 47 of the CARES Act. What we're advising is that you paid to the 75% or no less than 25% of prior, but we're not certain, based on the lack of guidance, how lenders are supposed to compare the wage levels of a prior quarter's wages versus an 8-week period. Nor are we certain how they're going to compare it on an employee-by-employee basis when you have different turnover going on in your staff between the two periods of time. So there's a lot of uncertainty around how that calculation and evaluation by your lender is going to occur. So we're also still unclear regarding the June 30th provision And that's the provision a lot of people are rightfully paying a lot of attention to. Marco Rubio was, I believe, even on a webinar this week, and he kind of described it. This is secondhand, of course, but essentially that if employers are having issues meeting the FTE count during the 8 weeks, this provision allows a little bit more grace period, so that if an employer reestablishes employment levels equal to around February 15th employment levels, then they can do away with having to figure out that FTE calculation methodology, and will get essentially a grace or a waiver on that stipulation, because by June 30th they were able to reestablish to full-time employment.
Now, this is my favorite part, and I get to ask you guys some questions that our clients at both of our firms have been posing to us. And so, Michelle, the first one is for you. What is required for rent payments? For example, what if I don't have a contract or lease agreement that's in place?
So it is required that you have a lease agreement in place. So there's one of the things that you would need to provide with the loan forgiveness application. So, and that's one thing I don't think we've brought up yet. The loan forgiveness is not automatic. People will have to complete an application, which we haven't seen yet, and banks may have different ones, but there'll be documents that need to be attached to that. The lease agreement needs to have been in place prior to February 15th, and it should not be just set up now and backdated. It should have been in place at that time.
Great. Mark, I'll pose this one to you. I got my money on April 16th, but I'm just now paying payroll. My staff was on unemployment until April 25th. How does that work?
Yeah, how does that work? Well, essentially in that case, it as of right now, and we're hoping that there's some changes, but there's a hard date of 8 weeks starting the date of loan origination, which we view as the date the loan was funded to the employer. And so the FTE count, which we may have passed over, is an average over that 8-week period of time. So if between the 16th and 25th you didn't have any employees back, then you would have that be a part of your averaging over that 8 weeks, and so you would need to make up for it, or be able to speak, address it later on in that 8-week calculation. Now, the question reference going back in time and trying to pay people for a prior work week, and it also mentioned unemployment. So there's some really big issues there employers and employees have to discuss, so that there's some clarity. If an employer was to say, okay, I meant to pay these people from the 16th to the 25th, but meanwhile all these employees have been claiming unemployment insurance for that same time period, you're going to run into issues essentially down the road where your employees are going to be forced to repay unemployment insurance for those time periods. Going back and backdating or redoing can open up a can of worms, in particular when you're dealing with employees that were still on unemployment. So, I would say, the most conservative thing would be to bring them off of unemployment as of the 25th and start paying them as of that time period going forward, but realize that first so many days is going to be a detriment into your averaging of FTE counts. You may need to make up for that by hiring more people later on, or maybe that would be an area where you're really going to hang your hat or hope that June 30th stipulation is one that is going to be your saving grace, if you will, so that because of a state or local order you couldn't bring them back to work, so that was the right business decision at the time to keep them on unemployment. And so the FTE count may be something that you're trying to bypass altogether and hope that that June 30th provision is in your favor, and that you have full-time employment at June 30th to provide to your lender and seek a waiver of the FTE count because you've complied with the June 30th stipulation.
Great. Let's see, this next one's also for you, Mark. If I have a separate bank account, do I have to pay directly from that account, or can I transfer money to my operating account to pay those expenses?
Yeah, this is a great question, and Michelle and I touched base before this on this, and her firm and us have been receiving many of these similar questions. I like to just slow down and kind of talk about why the separate bank account was recommended first. And I think people need to have an awareness that the sophistication level in small businesses varies greatly, in particular with their accounting abilities. And so I like to explain, I tend to get this question from more experienced accountants and bookkeepers saying, I don't need to set up a different bank account. I can track it, and they're correct. They can do that. But just remember that a lot of this guidance is out there to help the small business owner who essentially is doing their own bookkeeping, and those people tend to live on whatever cash is in the bank account and spend it down rather than accruals and tracking expenses and understanding future liabilities and things that accountants and bookkeepers can understand. So realize some of this guidance is out there to be general guidance for the majority of small business owners across the country, and not just your more sophisticated business. Now, to the questioner's point, we're advising just what they're alluding to. Keep the money in a different bank account. Make transfers into your operating or payables account to offset the costs that were directly allowed for forgiveness. So when you look at a payroll run, you have your payroll processing fees from either ASAP or whomever is doing the payroll. You have your employer Social Security and Medicare taxes coming out as well. You have other costs that are in there that are not allowable under PPP, as we addressed in the first presentation. So we, and I know most payroll companies, are providing some sort of report that will detail to employers specifically what is allowable PPP. So basically gross wages plus state unemployment plus employer match for retirement plans or something that are generally tracked with each payroll. And so that number is how much I would be transferring from my PPP holding account into my operating account with each payroll run, so that you can turn around and present to the banker a detailed paper trail for each transfer out of that account, showing that's how I use the funds. And the same would be true for utility bills or anything else that you're paying out of your operating account. And that's especially if you have your utilities on some sort of ACH debit method with the utility company. You don't want to have to go to them and say, hey, please deduct it from this bank account for 8 weeks, and I got to go back and change it back to my operating account in 8 weeks so that they hit the correct account going forward. For simplicity's sake, it's probably much easier to keep it in one account and just make line item transfers and then paper trail each transfer, documenting what the transfer was used for.
Yeah, if I could just add one other thing, really at the end of the day, it's that you have spent the money on the eligible costs, you have tracked those and documented that. And so whatever is going to be simplest for that particular business, and every business is different. One business may not want to set up that separate bank account. It may cause more confusion to have a separate bank account, and another business that may help them. So it really is what is going to help them with the tracking is most important.
That's a good point, Michelle. I think understanding that this isn't a requirement.
Right.
Sometimes when accountants say we're recommending you do this, this is just being very conservative and making it easy on your lender. It's not a requirement. If you didn't set up a different bank account, that's fine. You'll be okay. You just need to document the use of funds, and this is an easy way for people to wrap their head around where the money was spent, because they're not seeing a whole bank statement filled with transactions in and out of your account that confuses the lender. You know, having it in a separate bank account and only having specific transactions that are directly attributable to allowable use of funds is just a clean look. And so that's kind of, you know, why we're recommending that.
Great, thank you. So the next question is, what if my employees decline to return to work? Michelle, do you want to take this one?
So that one is a little bit tricky. So the employer, there's some information where the employer can fill out a form if an employee refuses to return to work when they have offered that. However, the employer would need to document the offer of rehire and document the refusal of the employee to come back to work. And then the employer would be able to, that would not count against them with the calculation of the forgiveness and the FTE. However, that would potentially impact that employee's ability to receive unemployment, continue receiving unemployment, and potentially jeopardize having to pay back unemployment expenses, as if they have received an offer of employment that is supposed to be reported to for unemployment.
If I can expand a little bit, Michelle.
Sure.
And Diana, I think people don't realize what goes on behind the scenes. This July and August, there's going to be a flood of, I think they're called UIB 144 forms. And basically it's an unemployment insurance benefit, form that is sent out to employers, and it's going to start requesting work week specific earnings by their employees who during the second quarter also had received unemployment benefits from the state. And that the trigger mechanism for that is related to the UITR wage reporting that employers are required to make every quarter. And so if during the second quarter the state database sees that an employee received benefits and then also sees that they were paid by this employer, that triggers the letter to automatically go out. And so there's going to be an audit on a work week by work week basis for all of these employers to submit to unemployment, and then unemployment's going to have to reconcile that and say, well, this person was actually working for that employer and he was claiming he wasn't working for that employer. Therefore, unemployment's going to go back to the employee and request a clawback of those monies. And they have power behind them as the state government to impose those things on employees. So just keep that in mind. That's a mechanism behind the scenes. Now, in relation to this question specifically, there's a reporter for the Denver Post out there that I've been following, or Colorado Public Radio rather, and he said as of yesterday, 150 people have been formally reported to the Department of Labor under this online form as refusing to return to work, and that the state has processed 55 of those claims. And so far, the vast majority, about 50, were allowed to keep their benefits. So it's not an automatic. There's some sort of determination criteria that the state's going to be looking at, because there are worker safety concerns out there that are legitimate. And I don't know what the standards are. And we're hoping that this reporter for Colorado Public Radio can get an answer from the Department of Labor on what that next level determination is going to be, because you're going to get into situations where an employer said there was a request to return to work, the employee refused. And that's on the unemployment benefits side and the eligibility side. Meanwhile, and I think we addressed this somewhere in today's webinar, there's some new guidance saying that in terms of forgiveness, that if you make that request to return to work, they refuse, and you document it, that won't negatively impact the employer's forgiveness calculation.
the refusal can be, you know, it could be someone is earning unemployment and would make more on unemployment than they would returning to their previous job. But there's also the fear factor of not feeling safe going back to work, depending on that employer's practices and the particular job and contact and that person's risk factor. So they could be making that decision because they don't feel safe.
Yeah.
Yeah, absolutely. And that was super helpful, Mark, to break it out in terms of the backside of things and from the employee and the unemployment's perspective, then from the forgiveness perspective, and kind of wrap that up. It does say that that's question 40 actually in the Treasury's FAQs, and it does say that the SBA and Treasury intend to issue more guidance in this area. But again, in terms of what to do now, documenting that documentation in terms of the refusal to come back to work is going to be your key in making sure that it doesn't count against your forgiveness.
And we have a link, I believe, on our website to the Department of Labor link to where employers can submit their employee names that they need to, that have refused to return to work, that kind of thing. So.
Great. Okay, now we're moving into a new section, one that's still a little bit unclear in terms of standardization, but to provide some guidance here would be great. A lot of people are asking questions on, you know, what records do I need to keep? And I think, again, just to kind of piggyback on what Michelle said earlier, that these loan forgiveness is not automatic. You will need to apply for forgiveness. And the documentation and reporting that's required may vary slightly from bank to bank even. And essentially what you should prepare for is it to look like an audit and to provide all the backup documentation and records. It's going to be really important that you can certify and attest that you need these funds to weather this storm. So again, getting back to that, you know, your impact of how we were impacted by this. And so again, you're going to have to attest that probably again in the forgiveness application process. We don't know when the banks will open up those forgiveness applications and provide more guidance on that. But again, we do believe that once you submit the forgiveness application, the banks then have 60 days to determine your eligibility for forgiveness. So here, we just want to go over a few things of what you can be doing now in terms of keeping those records and documentation. This is a slide that we covered in part 1 of our forgiveness webinar. And I will kind of brush over it a little here because we covered it in detail during that webinar. But Michelle at Tafoya Barrett Associates put together a great list of things that you should be keeping records of. So copies of payroll tax forms, copies of payroll reports for each pay period. Mark even mentioned making sure you have records for each work week. So the more you can read through this list and complete, and also refer back to our part 1 webinar, but the more detailed of records that you can provide, the more you're going to be better prepared for that forgiveness application process. We have seen a few people create tools, an Excel workbook that you could use to track this information and also calculate that forgiveness amount. This is just a screenshot of an Excel workbook that we created here at ASAP. That's a very kind of simplified way of tracking. And so you can see we kind of color coded the different sections, and then at the bottom you see the tabs. These are the Excel worksheets along the bottom. And so this is kind of the cover sheet, and all of the data from those Excel tabs and the different workbooks in here are funneling into this. So it has some formulas built into this. And this is just a sample. I mean, you could easily create something like this on your own. We have also seen the Colorado Office of Economic Development and International Trade released a much more extensive one. And so there's lots of people kind of coming out with these different tools and workbooks that people can use. And these are all super helpful. We do hope that we see some kind of standard one come out. Michelle mentioned that the AICPA is working on creating one. And so we might see different versions of this come out. We're, also trying to work with the banks to see what is these kind of workbooks going to be acceptable to them. So there's still a lot of gray area in this, but these are just tools to help you kind of track that. And again, make sure you have all that backup documentation. So, trying to be organized. This is another screenshot of the co-edit tool. And you can see on this payroll tab that they have, this is a lot more extensive in terms, but this, to kind of the layman's business, this seems very complicated too. So again, we hope to see some sort of standard come out in terms of a tool, but for now, just start using something to stay organized and keep track of these records. Okay, getting into our kind of conclusion section. So I want to talk a little bit about the safe harbor provision that came out. And this is specifically in terms of question 43 of the Treasury FAQs that were updated on May 6th. And essentially, this is a pretty big legal question and definitely gets into a lot of legal gray area. And so we're trying to seek guidance from tax attorneys. But essentially, what you could understand here is that the forgiveness and refusal of an employee to return to work, or the ability, essentially you can return the loan by May 14th and possibly even use the ERC credit instead of the PPP loan. And this was something, the May 14th deadline was even something that was recently extended. And so those, again, were updated on May 6th. And this kind of gets into a lot of the news headlines that we've seen in the last few weeks regarding big box businesses accepting PPP funds and then now returning them. And so there's a lot of caveats in there, but again, this is something that was updated in that May 6th updates. Michelle, did you have anything to add on this particular slide?
Well, I have also heard of even some smaller businesses being concerned. I mean, the original application talked about that you could apply for the PPP loan, based on a level of uncertainty. And that uncertainty is a big word. There's uncertainty around what does that mean exactly? So it talks about, did you have access to other forms of cash, of capital, of credit available, and did you really need the money? This was intended to help small businesses and help people keep employees employed and off unemployment. So, what I've been seeing is that if you've gotten the funds and you still, you believe all that to be true, that there was uncertainty, you really did feel like you need that to spend the money on the eligible costs and move forward. Some of the companies that are returning the money got, millions of dollars. And I don't know that it was necessarily designed for that.
Well, Michelle and Diana, I think this is it does address the political side of this that's come after the fact, unfortunately. And so everyone made their determination based on the uncertainty in their certification on those SBA application forms back 30 days ago at this point.
Right.
Some of them, when was that now? And so to come out after the fact with a bunch of new rules or interpretations is very complicated, to say the least. But I think to be prudent, alluding to what Diana said earlier, it wouldn't hurt to go ahead and revisit that application with your executive team or board or whomever. Document why you were uncertain at that point of time and why you felt it necessary to make that application at that point in time. and that it applied to you because of the uncertainty and what that uncertainty looked like for your business or nonprofit at that point in time. And you know, have that written down now, and if you need to seek advice from a lawyer right now, that would be another prudent measure to take to see if they want to put that in a special meeting of the corporate board or whomever. That would be one step to go about. The other area of concern here, well, the safe harbor mechanism is a mechanism to encourage those big box stores essentially to return the money. And in one of the FAQs in the last 10 days was mention of audits of loans over $2 million, which are probably not loans Michelle or I are seeing right in our businesses, our client base, for the most part. So those are kind of who they are initially targeting, but I think it's prudent for all businesses to revisit that. I don't think it's you know, a concern for panic, because uncertainty is huge right now. No one knows how long this is going to go on, but it does point to kind of one of the initial kind of goals of PPP was to get people off unemployment insurance and stay on payroll so they can retain their employee benefits through their employers and health insurance in particular. And it's complicated that, because now Treasury's coming out with statements saying forgiveness is going to be potentially scrutinized and these loans are going to be scrutinized more, and that creates some fear within the small business community who doesn't have a lot of room for mistakes or to repay this money. I mean, you know, these are not big box employers that we work with. These are employers that this is their livelihoods on, you know, that essentially are at stake. And so, you know, it's something to consider if you feel like employee retention credit could be a better path for you. But we essentially, I've been telling people for the last week, use the funds, get towards payroll, as much payroll as you can. You may not get 100% forgiveness, but that's okay. You'll still get a benefit out of this by paying as many of the employees that you can put to work right now and over that 8-week period. And then maybe June 30th, you can come back to full employment and you'll get even more forgiveness. You may not get full forgiveness, and that's okay. It's 1% of the loan, and it's not a huge number. But try to use the money in the spirit of the law as best you can, and be prepared at the end of 8 weeks or at the end of June to repay whatever or convert it into a traditional loan at that point in time. I'm also telling people to be to kind of hold off on those concepts of paying people not to work, because that essentially is a risk to you, the small business owner. The Marco Rubios and everyone may be out there telling you to put people on payroll to get your numbers up, but if you can't put them to work to the benefit of your business, you're exposing yourself to potentially not getting that money forgiven down the road in full. And so you've essentially paid someone and not getting forgiven. And so I don't know if that's the right direction to head, to put people on payroll that aren't working. And so there's a lot of concern in this whole forgiveness, and I think we're aware of that. That's why our phones have been ringing off the hook in the accounting industry, and that's why this is our second webinar, and why we're a little frustrated with Treasury not coming out with guidance on their deadline 12 days ago that they were supposed to meet onward and, you know, do it all. But thank you, Michelle, for presenting with us today, and I hope we're helping employers kind of wrap their heads around this.
Absolutely.
Yeah, that was a great conclusion, Mark, and definitely stay tuned for more forgiveness part 3, forgiveness part 4. I mean, we'll just keep going. Our website will, you know, we continue to update our help center. That's support.businessasap.com. You should see a lot of different sections as it relates to resources and relief during this period, and some best practices, and that's where we will continue to post updates. So as Mark said, Michelle, thank you so much for your time today and your insight. And Mark, thank you so much as well.
Thank you.
Thanks, Diana.